which we see in the investor behavior when you have a situation of prior gain or a prior loss. So remember the graph that we were seeing in the beginning? So when we are sitting on losses, our decision making or the decision process is different. And when we are sitting on gains, हमारा कुछ फायदा हुआ है और उसके बाद हमें कुछ financial decisions बनाने हैं, the thought process will be a little more different. Now these are the two impacts that we are going to study. So house money effect. So after a prior gain, so let's say you made 1,000 rupees in the stock market. Lagaya, beginner's luck hua, 1,000 rupees is what we are, won. And this typically we see in, the young blood or the young investors. So beginner's luck, shuru mein fayda hua. Do you think people will become more and more willing to invest in the stock market or be willing to trade? Yes, because if you have experienced success once, you tend to feel that, yes, let's do it again. So, जब एक बार फायदा होता है, then people are more open to assuming risk. And this is one thing, let's establish that every time we trade, we are undertaking a risk because there can always be two situations, either a gain or a loss, right? So every time we trade, we are taking a risk, but after a prior gain, when you've made some money, you will be more open to trade, you will be more open to assuming risk. Whereas what can happen in the case of a loss? Think about it, when you've already incurred a loss. So market gir gaya hai, you are sitting on a loss of, let's say, 10,000 rupees. What would you do? Would you again trade more or would you trade less? Now the answers again can be mixed. If you trade more, then you are actually thinking that let me average, right? This is something which is known as averaging karna, rupee cost averaging. तो पहले 40 में जोमेटो का शेयर खरीदा था, अब 20 पे आ गया तो और खरीद लेते हैं, एवरेज प्राइस बीच में आ जाएगा और कम हो जाएगा, तो जब बढ़ेगा तो आई कैन सेल इट, राइट? सो rupee cost averaging is what happens when you want to break even. So you incurred a loss, you want to break even, so you end up buying more and more so as to average it. The other impact can be, let's say I trade in a derivative segment और मैंने F&O में बहुत नुकसान हो गया मुझे, and then I was like, okay, fine, I am never going to enter into this segment again. This is a snake bit effect. The name itself is very clear. एक बार ही सांप ने काटा, दोबारा नहीं जाएंगे उस जगह पे. So you become more risk averse. So there can be two things depending on whether you have a prior gain experience or you have a prior loss experience, and this is what is going to change every time, right? So these are the two different types of effects that can possibly happen based on what and how you are dealing with. Now let's do an example of this particular situation and see what decisions do we make as investors. So here is a situation that I've given you on the slide in front of you. Let me just go through this. And meanwhile, I request everybody to read it and kind of make a choice on their own. What do we want? Option A or option B? So the situation here is that you've bought 100 shares of company ABC for rupees 40 per share. So that means you have a total investment of 4,000. In the following trading period, which can be probably the next day, the share prices increased by 15%. So that means the share price from 40 to it became 46. Now, as an investor, what would you do? You have two choices. First is that you will immediately sell your investment with a position of gain of 15% and realize those gains. So 40 का 46 हुआ, बेच दिया और अपना gain realize कर दिया. Option B, which is a risky option. You will keep your position with one more trading day, where again there is a possibility. Share price 15% से बढ़ सकता है, which is 252 rupees, or it can go back to 40 rupees, right? Now, in this given situation, don the hat of an investor, think about it, what would you do? Will you sell it, which is option A? Would you keep it, which is option B? And trust me, there are no right and wrong answers. That is why stock market is one place where two people think exactly the opposite. One buys, the other sells, and both are correct. Right? This is just to understand our risk, attitude, aptitude, and preference. So interestingly, yes, I can see everybody is, I have a mix of answers. Somebody says A, somebody is saying B, and equally divided is the group, right? Second option as an investor. Okay. So there is a qualifying option as well. What is the difference here? So here that we are sitting on a position of a gain, right? So I told you that we are in a position of a gain. And now when you have to make this decision, right? What do? We have this tendency to sell winners. Okay. So people who said option A, you are exhibiting disposition effect. This disposition effect is nothing, which just means that we are selling winners, right? We prefer the gains which are coming to us. If we go further, right, and let's flip the situation. Rather than sitting on the prior gain, let's make a loss of 15%. So here you bought the same share for 40 rupees, but now the share price is going to 34. It has declined. Now what do? We immediately sell the share at a loss of 15%, or you keep it another day in the hope that it is going to jump back to 40. What do? Option A, option B. Sorry. Okay, so I'm having answers where option B is clearly the preferred choice. What about others? Option A and option B. Okay, perfect. Again, mixed, and that's absolutely fine, right? Now, what does this disposition effect says? The disposition effect says that if you have a superior performing stock, which this superior performing stock was the one which has a gain, you will prefer to sell it too early. That means you would just want to realize that gain of 15%. 40 का 46 हुआ, बेच के निकल लो. पर यही अगर स्टॉक में लॉस है, which was the second case here, which is 40 to 34 हुआ, there were more people who were opting for option B, that they will prefer to hold it on. And why is that? Because we as investors are more risk averse when we are in the case of losses rather than the gains. So whenever we are faced with prior losses, we are more risk averse. And this risk averse nature is depicted, right? Is actually depicted through the examples that we've just discussed. And there is nothing right or wrong. We are just investors who have different types of biases. So this line here, which says tendency to sell winners and hold losers, is the main line of disposition effect. So if somebody wants to understand, so like prospect theory says investors are not always risk averse. Disposition effect says you tend to sell winners and hold losers. These were probably the two technical ones. Now what we go is very, very simple. So there is something which is known as herding effect. Herding effect is, so we've always seen a herd of sheep or a herd of cows, which is bheed. We as human beings, again, we find comfort when we are large in number, majority, right? So people are influenced by each other, and we seek unconsciously that crowd is right. And this is where this statement, which is wise crowds become foolish, is very, very true, especially in the stock market. There's a very famous quote which says, when the shoe shiner starts giving you stock market tips, it's the time to exit the market. Why? Because it's the herding behavior. In the herding behavior, you are not analyzing, you are just falling prey to this information. This is a term, again, very, very established and popular, which is known as infodemic, like the pandemic of information, right? So much of information which might be irrelevant, which might be unreliable, social media, but we still fall prey to that. And that always happens subconsciously. So this herding effect is another one. moving forward, there is also something known as confirmation bias. Confirmation bias means that the way the information is presented, and when we have information to be absorbed, we have a tendency to interpret these new evidence as per our convenience. If it suits my belief, I agree to that. Something which is contradictory to my belief, I will undervalue that information, right? So we as people, we as investors, we generally look for supporting evidence and we disregard any contradictory evidence. Again, let me just give you an example of the same, and let's see how well we do in terms of a framing bias also, right? This confirmation bias also results in the under and the overreaction, by the way. But let's look at this. Okay, first let's look at this here. This is the image. There are two types of frozen yogurts here. One which says contains 20% fat, and the other says it is a frozen yogurt which is 80% fat free. If you go to the supermarket, what is it that you are going to choose? So quickly, what do you choose? Contains 20% fat or option B, 80% fat free? So 80% fat free. Okay, okay. Do you think, is there any tangible difference in the content, by the way? Right? So 80% fat free means there is 20% fat. But the way the information is presented to us, the way the packaging is done, the way the information is stated, we are tempted to go for one particular packaging rather than the other. We are tempted to go towards one particular brand, right? Both are the same. There is no difference. Absolutely right. Let's come here. And if you follow my pointer, the first line is longer than the second line, or the second line is longer than the first line. So you need to tell me in the chat box which line is longer, first or second. So which line is longer, the first or second? Okay, I have a very intelligent participation here. They both know that the lines are equal, but B is looking bigger, longer, right? Absolutely right. So the lines actually are the same, and it is a very, very popular Miller-Lyer illusion where the lines are actually of the same length. It's only with this particular part of the line, the direction of that arrow which differs, and it makes the B look longer, right? And now let's come to something which we generally have always been hearing from all those TEDx talks, that the glass is always half full, half empty. You should always look at the full side of it. But does it actually make a difference? So if I say this is 66% empty or this is 33% full, they both mean the same. But we are tempted by, when we are impacted, or the information is presented in a certain way, our decisions are impacted. So this is what these illusions or these illustrations help you to see, that there can be a framing bias. Now, let me just go to this. And here is a situation from a public policy. So we were recently impacted by COVID. And let's say, so India is preparing for that. It is going to kill 600 people. And the doctors have proposed, there are two programs. And the two programs is program A, if it is accepted, then 200 people will be saved. If program B is accepted, then there is 1/3 probability that everybody will be saved and 2/3 probability that no one will be saved. Which program are you going to select? So as a public policy decision maker, you need to make a choice between A and B. What do you choose? Between A and B, what do you think? Oh, I have options from B as well. Okay, what about others? A or B? B. Okay, great. So I think we've got the hang of this exercise. If program A is accepted, 200 people will be saved. When I say I accept program A, I am again exhibiting the risk-averse nature given the framing bias, right? Both are technically the same. In both the cases, the end result is going to be the same. It just, is asking you based on how the information is presented. So this was a survival frame where the tendency can be to select one. If we are looking at the losses frame, right? Again, the same situation, two programs. Program C is accepted, 400 people will die. If program D is accepted, 1/3 probability, no one will die. 2/3 probability, 600 people will die. Which program will we select? Where 400 people are dying, or program D, where there is a different probability? So I would again request to make choices, and these choices are not something which is to be done after careful analysis. This is just an exercise to inquisitiveness and the instinctive behavior. Okay, option A, great, wow. So what this framing problem says. So right now I do realize that I've activated both the right and the left side of the brain of my participants. But what does this framing exercise say? That if majority choose program A, they are exhibiting risk averse. Why do we say risk averse? Because we are starting with a situation of full mortality. Everybody is going to die. And then we are moving towards partial survival. Right? So this is a survival frame. We are going from extreme negative to the positive. Whereas in the mortality frame, if we look into it, we are starting from full survival, right? And then going towards partial mortality. So these are these different frames which kind of tell you that the framing, how the information is presented, right, can influence the decisions. And these decisions then can be inconsistent. And these inconsistent decisions result into irrational behavior of people at times. And these behaviors can be exhibited anywhere and everywhere. Right? So, let me just clarify. I thought I should have done this earlier. All of these exercises and questions, they are well established in the finance literature. There's not even one question that I've created myself. I am not the creator of these questions. These situations have been tested in a form of experiments over the years, and experiments have been done. Okay, quick answer without too much of calculation, right? What will be the quick estimate for the product of the 8 numbers that are shown below? 1 into 2 into 3 into 4 into 5 into 6 into 7 into 8. What is the answer? Option A, B, C, D. Quick. I don't want correct answers here. I just want what is the first instinctive answer that you would choose. So between around 1,000, around 500, what do you think the number will be? Around 10,000, what do you think the final number would be after multiplying all these numbers together? Or it will be around 40,000 something. Closest answer. It has to be just an approximation. What is the closest proximate? Right? So the correct answer here, if I have to tell you, the correct answer here is 40,320. Okay. Now, after calculating, we can all go there. What does it show? Why would you not go to point D straight away in the first 30 seconds or so? Because when we start from these smaller numbers, right, our mind processes this information at least for the first 4 numbers. So you go into 1 into 2, 2, 2 into 3, 6, 6 into 4, 24, 24 into 5 also. But beyond that, you stop calculating and you go into the cognitive bias zone. So this is why, and if the other way, which is in the experiment, the other way is when we just flip these numbers. So if I give you a number which is 8 into 7 into 6 into 5, your answer will always be higher than this one. Whatever be your answer will always be higher than this one. So this was just another, right? Where how do we start the information? How do we process the information where when we are absorbing it is an indication. Now, this is very interesting. One of my favorites, which I have been using as a child quite often. We go to a supermarket, there is a thing that I want to buy. There are two bottles, let's say, of perfumes. One is $10, the other is $30. I feel $30 is very expensive. And suddenly the shopkeeper comes and keeps the third bottle, which is $50. And I suddenly start feeling, oh, that's okay. $30 is reasonable. It's somewhere in the middle, and I can go and buy and, end up buying it. This is what is called as the decoy price. Decoy, which has no reasonable relationship or no reasonable meaning to influence this decision making of buying a $30, product. But just because you are, visualizing something as a more rational, reasonable choice, you end up buying that. So this is another which is called as decoy effect. So where the information is presented in a certain manner, that one which was looking expensive a couple of minutes back starts looking reasonable. Now let's go to mental accounting bias. How many of us have heard about, the KBC winners, jo Kaun Banega Karodpati, where they become Karodpati and then in 1 year they become Rodpati again because they are not able to manage, the money that they've done from the gain. Whereas these are the people who would strive the entire life and still not make 1 crore of rupees as a livelihood. This is precisely because the mental accounting bias. Mental accounting means that when I receive money, which is like from a lottery, and when I earn the money, which is like maybe a salary, I treat both of them differently, right? What I earn from my salary, I may be more, conservative in my approach when I have to invest it. But when I get something, maybe, it is passed on from the generations, or it is from a lottery, or it is a capital gain, you start treating that money in an illogical manner. And people have done that. And there is ample evidence in the literature where people have seen that you have a higher risk appetite with the money that you receive in the lottery. Again, this is not right. Money is money. The value of that 100 rupees is going to be the same, whether you are earning it from salary or you are getting it from a lottery. But this bias ends up treating, making you treat both of these money differently. So the next one that I have is a familiarity bias. Again, this bias is very well studied in the finance literature. When you invest only in your own company or in your own country, because these are the things that are familiar to you. This is called as familiarity bias. And in the finance literature, I have my friends and my senior colleagues also. There is a term which is known as home bias. Home bias is a observed phenomena where domestic investors prefer domestic stocks. So a US investor would prefer a stock in US economy. Indian investor would prefer a stock in the Indian economy. And they get all that comfort, from the same cultural setting, same legal rules, informational advantage. And that is what leads to familiarity bias, right? So in spite of so many international mutual funds giving an option for you all to invest abroad, as a percentage of the total Indian investor population, the number is still very low.
Hello.
And the reason is investor bias, right? Now, that is where, I come to another one, which is called as survivorship bias. And that probably will be the last one, I think, which we can discuss right now because there's paucity of time. So survivorship bias, we all have faced through that. So this is something where, we see that one person on the top and we feel that if they have done it, anybody can do it. And that person also likes to propagate that. If I can do it, anybody can. But remember, this is a pyramid. There's a lot of failures in the bottom, which is 99.9%, who have failed. And there is the 0.1% who have succeeded. So this survivorship bias is actually a phenomena which manifests itself into a distorted reality and a distorted interpretation, right? Where we feel that, okay, fine, college dropouts like, Facebook, Google, WhatsApp, everybody, if they can do it, I can do too. but then you overestimate the odds of success, which is overweighing the probability. And that is where your survivorship bias comes in. When we see the index automatically, the stock market index, it automatically filters the weak stocks every time it rebalances. There is a survivorship bias there as well. Why? Because we are only considering the surviving observations. We are not looking at things which have failed, right? So a stupid decision that works out well becomes a brilliant one in hindsight. That is one of my favorite quotes, which I have often seen being applied in real life as well. So I mean, there was a decision which might not have been that great, but because of the conspiracy of the entire, situations, good luck, everything, it turned out to be a brilliant one. So Bill Gates, Mark Zuckerberg, they became millionaires, right? Millionaires, and they are successful. But what is the percentage that you are going to be one? So it might look as a brilliant one in hindsight, but we need to examine what is that probability of loss. And this similar thing, right? This similar phenomena should be done every time when we are investing in the stock market. Why? Because once we are aware about our risk-averse, risk-seeking behavior, the differences and the divergent behavior that we have, we will be able to, kind of avoid these fallacies. And next time we will not complain. Market गिरी थी तब नहीं खरीदा, अब जब market चढ़ रही है तब खरीद रहे हैं closer to the 52-week high. You will be able to benefit from making knowledgeable, educated investment decisions by just, managing the behavior. So I think that is where I would end. And if there are any questions, and first of all, I mean, I apologize if there was any misses that I made during the presentation. But one more, just last bit. Anybody who would, who found this topic interesting and wants to read more about this, these are two books, which is here, Thinking Fast and Slow by Daniel Kahneman and Fooled by Randomness by Taleb. They are the ones which I have read and gained and understood whatever little I have understood of behavioral finance. Everybody feels free to read for that as well. Thank you so much. Thank you, ma'am. Thank you, sir. Thank you, everybody. Ma'am, आप म्यूट पे हैं.
Yes, I congratulate Tarunika for such a wonderful lecture. And, we have actually learned, although my area is also finance, but, having this kind of an insight was actually because we are too busy in taking the other subjects, and, this subject is lagged behind, because unless and until you research in a particular area, the contemporary issues are missing. So, this kind of lecture series, what Shri Aurobindo College Morning has started is an excellent endeavor in the knowledge sharing platform, and all the more in the new education policy. If you talk about, we should add different flowers to a bouquet to make it more beautiful. So that's what we are doing. And we are on to the innovative teaching pedagogies also, wherein a combined programs are conducted by our college, which is the student development as well as the faculty development programs. So it's a win-win situation for all of us, and we welcome such initiatives. And my heartiest congratulations and kudos to Tarunika for such a wonderful presentations. Thank you so much. So on to Shasta, please.
Thank you so much, ma'am.
Thank you, ma'am. Thank you, Dr. Tarunika Jain, for such a wonderful presentation. I need not say anything. The chat box is full of congratulatory messages. And trust me, you totally bowled it. And I was just speechless to see your presentation going, and so many concepts, so many biases, everything, every decision, every emotion that we are exposed to in the investing world. You explained everything so beautifully in such an explanatory way. And it was so difficult to actually write down the report for this session because I was totally captivated in your session. So I have given a few misses in the report as well because I was totally into your presentation, and that testifies how wonderful it was.
On to our
Thank you so much. And coming to our organizing team and Sir Principal, Sir Professor Vipin Kumar Agrawal, sir, thank you for being the pillar of strength for all these sessions. Without your support and guidance, we would never be able to execute these
Shasta, just for a minute or so, I would like to congratulate Department of Commerce and the teacher in charge, Dr. Namita, for organizing this lecture series. And I must say that this lecture was really very informative for me, at least, in the sense that this topic is quite close to my heart. And I've been teaching in the past the fundamental of investment paper. And every time in the classrooms, we teach technical analysis, fundamental analysis, but practically nobody talks about the behavioral aspect of the finance. And as Dr. Tarunika said, 7% of the people, 7% is only the smartness in the sense fundamental and technical. Rest all is behavioral aspect. And I do tell you that in my own experience also, because part of the, frankly speaking, part of my saving, I do invest, I do park in the mutual funds and these SIPs. So when this COVID came, I stopped my SIPs because I thought this is my hard-earned money, and this hard-earned money, I can't lose more because I have whatever the little saving I do have, I do park that. And this is what practically happens. Had I that time kept my SIPs, the return would have been 35% to 40%, even higher. I'm telling you the conservative figure. So this topic which Department of Commerce and Dr. Tarunika has chosen is really very important, and all the students, the faculty, and even the general public in general, in the sense those who have savings, that they must learn the behavioral aspect of the finance. So for that matter, I would like to congratulate Dr. Tarunika, and I will discuss some time with her. I will take a class from her on this very topic, on the behavioral aspect. I'm sure.
Your presence and the presence of all the senior teachers, I mean, my teachers as well, I should say, and all my fellow colleagues have motivated me. I can't tell you how honored and how good I feel about it right now. You were
So,
through the
congratulations to Dr. Tarunika for a wonderful lecture, and congratulations Department of Commerce.
Thank
and
you
the
so
teacher in
much.
charge and all the team, the organizing team. I can see the organizing team. I'm not naming people, but I must thank all of them on behalf of the college and on my personal behalf. Thank you very much.
And thank you, Namita ma'am, for making us work on these initiatives. And this is certainly helping all of us a lot. And I would really encourage Tarunika ma'am to take online classes so that we all can join for future lessons. It was truly amazing. Thank you.
Important takeaways to our participants. So please share your presentation to all of us so that we are all, having that takeaways. Because, when we join any kind of a faculty development program or anything, so we always look for some good takeaways. So the things which we have missed and slipped, so we can,
Sure,
catch up again. So please share the presentation in the chat box to all of us. And we have the email IDs of all the participants, so we can share them on the email IDs. Thank you so much, everyone, for being a part of this wonderful lecture. Thank you so much. So we end the meeting. Thank you.